You were told your credit score measures responsibility. You were told it reflects character. You were told pay on time and everything will be fine. But that's not the full story. A credit score doesn't measure how good you are with money. It measures how predictable you are inside a lending system. And more importantly, how profitable you are as a borrower. This video isn't about fear. It isn't about conspiracy. It's about understanding how credit systems work in the United States and in other developed countries. Because once you understand the design, the outcomes make sense. In the United States, credit scoring emerged to solve a business problem. Banks needed a fast way to decide who should receive a loan. When lending scaled to millions of people, manual judgment was impossible. So models were built. These models analyzed past behavior, payment history, outstanding balances, defaults, bankruptcies. From that data, a single number was created. Not a moral judgment, a probability. The probability that a borrower would repay. That number became the foundation of modern consumer lending in America. A prediction might seem objective, but it isn't neutral. A score that tells lenders this person is unlikely to default also tells them something else. This person is only valuable at the right price. Over time, credit scoring became an industry, different models, different versions, different incentives. Lenders don't just ask, will this person repay? They ask, how much revenue can this person generate over the life of the relationship? Interest, fees, cross-selling, repeat borrowing. Risk is only half the equation. Profit completes it. Here's where many people get confused. If you pay everything in cash, avoid credit cards, never take loans, the system doesn't see discipline, it sees absence. Credit models depend on data. No data means uncertainty, and uncertainty is priced as risk. That's why someone who avoids credit entirely may receive worse offers than someone who uses credit carefully. Not because the system hates cash, but because the system can't measure cash behavior. Visibility matters more than virtue. In the US, there is no single credit score. Different lenders use different models, different versions, different thresholds. The score you see is often not the score a lender uses. Mortgage lenders, credit card issuers, auto lenders, each may rely on different calculations. This is why two lenders can see the same person very differently. The score opens the door. Business rules decide what happens next. The UK operates under a similar principle but with different rules. Multiple credit reference agencies exist. Each maintains its own dataset. Each calculates scores differently. Consumers often see one number. Lenders may see another. The score is not a universal truth. It's a tool, one that lenders choose based on cost, convenience, and risk appetite. The outcome remains consistent. Access depends on predictability. Now, Australia uses different scoring ranges. Some systems score up to 1,000, others up to 1,200. But the purpose is the same, to decide who gets access and at what price. Because different bureaus collect different data, a person's score can change depending on which bureau is consulted. The number changes, the logic doesn't. Across countries, there is no single global credit truth. There are approximations, models optimized for lending decisions. Consumer-facing scores are educational tools. Lender-facing scores are commercial tools. That gap creates confusion, and confusion creates dependence. Credit models are proprietary. The full formulas are not disclosed. The explanation is simple. Transparency could allow manipulation, but the trade-off is real. Consumers can't fully audit the system. They can't see bias clearly. They can't see how profitability influences outcomes. Data inclusion expands slowly. Rent payments, utility bills, telecom records. But data is added when it benefits the market, not automatically when it benefits the consumer. Credit scoring affects life outcomes, housing access, interest rates, insurance pricing, employment decisions in certain jurisdictions. Those who qualify for low-cost credit build assets. Those who don't pay more to survive. This isn't about intelligence, it's about structure, and structures compound over time. A typical decision looks like this. First, the score filters applicants. Below the line, declined. Above the line, evaluated further. Then comes profitability modeling, expected revenue, customer lifespan, product attachment. The final offer is not just about safety, it's about return. That's why responsible usage is rewarded. That's why activity increases limits. That's why inactivity can be penalized. A high credit score does not mean wealth. It means predictability. Cash-only living does not prove responsibility to a system that cannot observe cash. Credit scores are not identical worldwide. And improving a score is not just about paying on time. It's about visible behavior. You don't need to reject the system, and you don't need to worship it. You need to understand it. Use credit strategically. Pay in full when possible. Maintain visibility without dependency. The goal isn't to maximize borrowing. The goal is to minimize cost while preserving access. The credit score isn't a lie, but it isn't a virtue meter either. It's a market tool designed to scale lending, optimized for predictability, aligned with profitability. You can ignore it and be shaped by it, or you can understand it and use it deliberately. That difference is the line between stability and freedom. If this gave you a clearer perspective, subscribe. This channel isn't about motivation. It's about understanding the systems you live inside. In the next video, we'll explore how the system quietly rewards the people who escape dependency. Watch that before the system decides for you.